It's Friday, the 26th of June, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, a possible bit of good economic news to come for Andy Burnham if he does indeed become the latest occupant of number 10. But for now, we are still in the grip of a brutal heat wave. But it's going to take a lot more than that to keep Group Chief Economist Neil Shearing from joining me to trawl through another week in global macro and markets. Hi, Neil.
I'm not sure it is, David. I'm operationally out. It's pretty hot here in London. It's not much of this hot, it's just this country's singularly ill-equipped to deal with the heat. So as soon as anything goes above 30 degrees, everything starts to melt. But we're okay. Yeah, we're recording, so we're okay.
I'm conscious that my purchases of cheap Chinese fans on Amazon the last week have worsened.
Yeah, you're single-handedly responsible for the trade surplus.
Yeah, I know. There's much more to talk about that. But for this week, I wanted to talk about our global economic outlook. It's nearing publication, and it speaks to this idea that if you're part of the AI investment boom, you're producing the chips, you're making the servers, you're building the data centers, then your economy is having a pretty good time with it. But if you're not, then it's not. So in my reading, you've got the US, parts of Asia doing well, Europe, some other EMs not so much. Is that an oversimplification?
Well, as ever with these forecasts and outlooks, there's a danger of simplifying in order to kind of get everything into a single narrative. But I think broadly speaking, that's right. Yes, you've got a bunch of economies in Asia that are producing the hardware and the tech that goes into the AI investment boom. Korea, Taiwan, they're doing well. You've got the US, of course, that relative to developed market peers is doing relatively well too. So we can get into this, but our latest Q2 now, GDP nowcast is currently tracking at 2.5% Q on Q annualized. I mean, it's not going gangbusters, but they're the types of rates of growth that Europe can only dream about. And then at the other end of the spectrum, you've got Europe itself, which is stagnating at the moment and might just about eke out some positive growth over the course of this year as a whole. The UK may be just under 1%, something like that, but it's pretty meager stuff. So yes, broadly speaking, the US still in the lead, Europe still lagging behind, and tech-orientated emerging economies doing relatively well.
China as well. I mean, our China activity proxy, this is our independent read of our proprietary read of what's really happening in China's economy. The latest read of that was out this past week, and it kind of speaks to that point, doesn't it? Domestically, economy not doing that well, consumption not doing that well, but thanks to this AI investment boom on the industrial side, on the external side, it's really helping the economy, isn't it?
Yes. I mean, again, it's a two-speed economy in China. So you have domestic weakness and external strength. Now, part of the export strength, you're right, is related to the AI investment boom. But as I said at the top, there's a danger of oversimplifying here. And by no means is it just AI. Actually, when you look at China's export performance, the strength is pretty broad-based. But as you said, the overriding point here is that the economy itself is struggling. I would say the growth is pretty meager, kind of about 3% year on year on our China activity proxy. It might pick up a little bit over the course of this year as we get some additional fiscal support. But the broader picture is one of a kind of two-speed economy with domestic weakness and external strength. So you get this big trade surplus that we were joking about at the top. But of course, the serious part of that is that increasingly that's going to run into some pushback, I think, from for governments on the other side of the surplus, including in Europe.
You spoke before about how the US economy is doing. Specifically, you highlighted our nowcast. Thinking about the policy implications of what's happening there, because we had this latest income and spending data for the US. And the read from our US team is that this critical core PCE measure, this inflation measure that the Fed has been paying most attention to over the past few years, that's probably peaked. So if that has peaked, why then do we think that the Fed is going to be more hawkish than market pricing suggests that they will?
It's peaked, but let's get this into context. It's currently running in the May data that we just had that you referenced at 3.4% year on year core PCE. The monthly increase was 0.32%, if you want to get very precise, to two decimal places. Clearly, both of those numbers are inconsistent with the Fed inflation target of around 2%. So it's one thing believing that core PCE has peaked, but it's running well above the Fed's target. And I think more importantly, is going to be quite slow to fall back. So if you look at the detail of the May data that we've just had, the strength was pretty broad-based across particularly services. Yes, we're going to get some disinflation in areas like airfares over the coming months as that drop in energy prices feeds through. But in other areas, I think core inflation pressures are going to remain pretty persistent, and some may actually intensify. So we're speaking just after the news from Apple and from Microsoft that they're going to increase prices on some of their goods as a result of the increased costs of semiconductors and associated technology related again to the AI investment boom and the demand that's generating. So core inflation in the US has peaked. It's going to be quite slow to fall back. Hence the view that the Fed's got a bit more work to do.
Is market pricing making sense? There's Kevin Walsh's debut press conference, debut meeting as FOMC chair, delivered this massive hawkish shock to some in the market, at least, especially not capital economics clients who'd been reading our US analysis heading into the meeting and warning of this hawkish shift. Has it moved far enough?
So if you look at what the market's pricing in at the moment, they've got about 40 basis points of rate hikes by the end of this year, and then rates remaining broadly unchanged in the first half of 2027. So in some senses, the market's kind of buying into this idea that the Fed's got more work to do, despite the widespread assumption at the start of this year that the change of FOMC chair would usher in a period of lower interest rates. So that's turned on a dime, and the markets are now pricing in rate hikes. The question is whether 40 basis points is sufficient to deal with the build-up of underlying inflation pressures that I've just talked about. It's possible, but our judgment is that the Fed will probably need to do a bit more. So we've got 3 25 basis point hikes, so 75 basis points of rate hikes coming down the track. So my sense is that the markets kind of moved in the right direction. We've always kind of pushed back against this idea that a new FOMC chair would mean rate cuts because of the fundamental strength of the US economy and the strength of inflation pressures. The market's now kind of got some way to pricing in hikes, but I think on balance, the Fed will probably do a bit more than the market's currently pricing in.
Continuing this idea of US economy hot or not, we've got payrolls released in the coming week. It's a Thursday, unusually. It does feel like the single most important data point in the global economy today, but it's also one that has produced some of the biggest surprises, hasn't it, from month to month, not least last month where we had this bumper read of new jobs. So what are we expecting the June report to say in light of what we saw in May?
Well, I say it every month and I'll say it again. Yes, it's an important data release, but it's a really, really noisy one. I think there's often a tendency sometimes to overinterpret the payrolls numbers. The tension here is that clearly the US is the world's biggest consumer, the consumer of last resort. So the strength of the labour market is absolutely critical to the outlook, both for the US economy, but also the global economy. However, this is 1 month's data, the response rates to which have been collapsing and which is noisy. So we shouldn't overinterpret 1 month's data. So anyway, that health warning notwithstanding, I think it's going to be another pretty strong payrolls report. We're forecasting a gain of about 110,000 in non-farm payrolls. If you dig below the hood, that's supported to a significant extent by firms hiring both for the World Cup, the FIFA World Cup, which is included in this survey period, but also in advance of the 250th anniversary of independence celebrations that are coming up at the start of July too. So both of those events should give a bit of support to leisure and hospitality employment, and that's what's underpinning the strong gain of 110,000 in June.
So those are one-off of temporary effects.
Well, one-offs in the sense that they won't be repeated, but the labour market in the US is in pretty good shape. And of course, we're in a place now where labour supply is growing at a much slower rate. So 110,000, it probably will keep the unemployment rate at 4.3%, but it wouldn't be a surprise if it ticked down a bit. So we don't need very strong payrolls growth to keep unemployment at rates that most economists, including us, would agree is kind of consistent with full employment.
I'm conscious we haven't even mentioned Iran, the Strait of Hormuz, the Middle East conflict, probably for the first time in months on this podcast. And you have been telling a relatively good news story, but it would be nice to end on some of the risks, some of the downside risks. And it does feel like everything that you've been saying, certainly putting aside the sort of the World Cup and what's happening in US hiring for June at least, it does feel like this has all been quite dependent on this AI investment boom continuing. Now, there's clearly some anxiety about how long this can go on. If you look at the volatility that we've seen in semiconductor stocks, clearly this can't go on forever. And if it can't go on forever, then it will stop at some point, as the old saying goes. So what happens then for the macro picture? Is this a big risk to our forecast?
Well, I think there's several kind of risks that you can think about when you look at the global economy and the global economic outlook. It's obviously a question we get asked all the time. Yes, I mean, specifically as it relates to the AI investment boom that we're seeing at the moment and what role that's playing in driving economic growth. I mean, it's important, and if it went away, it would have a meaningful effect on some economies, but it wouldn't necessarily cause the global economy to nosedive, I don't think. So to put this into perspective, we think about a third of economic growth in the US at the moment is coming from AI and related investments. So if that was to just disappear overnight, rather than having that kind of 2.5% Q-on-Q annualized in Q2 that I was talking about, you might have growth somewhere in the kind of mid to high ones. Now that is pretty weak by US standards, but it's still stronger than growth that we're seeing in Europe. So yes, AI is providing a prop to the global economy and to growth in the handful of economies that we mentioned at the start, the US and those economies in Asia. Those economies would weaken if the AI investment boom went away. However, I don't think it would necessarily alter some of the narratives that have been playing out in recent years, including the outperformance of the US over Europe. I think there's a slightly separate question, which is what happens if the kind of excess or perceived excess in financial markets starts to dissipate? That's slightly different from the idea that the investment boom around AI starts to fade. So what happens if these very ambitious forecasts and expectations of earnings growth from the hyperscalers and the semiconductors firms that are underpinning stock market valuations at the moment, what happens if those are disappointed? And we start to get a big sell-off in equity markets? Would that weigh meaningfully on economic growth in these countries, even if the investment boom around AI kind of continues, then the rollout of AI continues? I mean, it would weigh on consumer spending, I think, in the US to some degree, but I don't think it would pull the rug entirely away from US consumers. I think the other point that's worth keeping in mind is in that environment, we'd start to have a shift from kind of risk on to risk off. So you would start to see some spillover effects to economies that have not yet benefited from the AI investment boom, but would be hit in an environment of kind of risk off. So I'm thinking here of emerging market economies who would see their currencies weaken and the spreads on their bonds widen. So they might get squeezed out of events. So I think important to differentiate between, are we saying about the investment boom in the real economy fading or coming to an end, or some of the kind of the speculative froth in markets dissipating? Those lead you to two slightly different outcomes.
Neil Shearing on the global macro outlook and the risks from this AI investment boom. That global economic outlook that we discussed will be published at the start of the coming week, and our global team will be talking about key takeaways and answering client questions about it in a drop-in, which is one of our short-form online briefings. That's being held on Wednesday at 10 a.m. New York, 3 o'clock London. Then on Thursday, our markets team will be doing a similar session around their new quarterly outlook at 9 a.m. London, that's 4 p.m. Singapore. Details of those events and all of the other drop-ins that we are holding on issues ranging from the Gulf economies after the conflict, to the commodities price outlook, to what AI is doing to the global economy, are all on our events page, capitaleconomics.com/events. If you're not yet a Capital Economics subscriber and want access to our regular online briefings, our written analysis, our data tools, and our global economist team, do drop us a line at podcast@capitaleconomics.com to find out more about taking a trial of our services. Now, it's been musical chairs in Westminster this week after former Manchester Mayor Andy Burnham returned as an MP, in all likelihood to succeed Keir Starmer as the UK's 7th Prime Minister in a decade or so. This is big news for the so-called Westminster bubble, and the speculation machine is in overdrive over who will be in and who will be out of a new government. Andy Burnham made headlines last year with much criticised comments about being in hock to the bond market. He's since walked those back, but there are still big questions about what his government could mean for the UK economy and markets. Fresh from publishing their latest UK economic outlook, Chief UK Economist Paul Dales and Deputy Chief Economist Ruth Gregory hopped on a microphone to talk about whether a Burnham government could really move the dial on the UK macro narrative and our striking call on how we're expecting the Bank of England to cut rates. And here's that conversation now.
So this week has been another one of those weeks where the UK is in the news for political reasons. Since late last year sometime, everyone's been worried about what an Andy Burnham premiership could mean for gilt yields and the bond market. But in the event, when Keir Starmer resigned as Prime Minister on Monday, which essentially seems to have cleared the path for Burnham to become Prime Minister, the markets couldn't really care less. So what gives?
Yeah, I think you're right. The markets did largely shrug off the news, didn't they, of Starmer's resignation. It may be that his resignation was widely anticipated, but it also may reflect Burnham's attempts to reassure the markets by committing to the existing fiscal rules. So we have seen this rapid evolution, haven't we, in Burnham's bond market rhetoric from we need to get away from this thing of being in hock to the markets to committing to the existing fiscal rules. Now, in terms of what might happen, I suppose we certainly wouldn't rule out a loosening of the fiscal rules. After all, Burnham has made it very clear that he wants to increase spending. But I think the true constraint on Burnham and the new Chancellor will be the market. And I think the gilt market will be highly sensitive to any signs of more borrowing. So against the backdrop of the UK's fragile public finances, I think a big unfunded loosening in fiscal policy would probably be asking for trouble.
And you mentioned, of course, the new Chancellor in there. Now, that's something we don't really know about at the moment. It does certainly seem that Rachel Reeves will be removed from her post, not least because if Burnham wants to signal that there's a change in regime, it'd be really hard to do if you keep Reeves in as Chancellor. And what we've been doing, I guess, is trying to highlight where could be slight differences between the way different people could be perceived by the market or the different policies they could have. So we've previously talked about how you can group the possible chancellors into two categories, those from the soft right of the Labour Party. So that might be Wes Streeting, Yvette Cooper, Pat McFadden, who might be, let's think about it, as more inclined if they're going to raise spending to cut spending elsewhere and not raise public borrowing much. And also the second group could be those from the soft left of the Labour Party, perhaps Ed Miliband and Louise Hay, who might be more inclined to raise spending and fund it partly perhaps with higher taxes, but also with some extra borrowing. So perhaps we haven't seen the final views of the markets here, because it might come down to who is the Chancellor, and the indications at the moment the markets would be a little bit more worried about anyone from the soft left rather than anyone from the soft right. Now, bringing these two things together, if you can sort of boil it down, there's been lots of rumours and chatter about Burnham's policies. Can you sum them up quite simply as what we think he wants to do when it comes to the government's fiscal policies?
Yeah, I think obviously we don't know about the detailed policy platform, and we won't know that until he starts setting it out early next week. But as I said earlier, Burnham has made it clear he wants to spend more. He's previously advocated higher defence, social care, infrastructure spending. He has advocated some tax hikes to pay for it, but he's also suggested some tax cuts. So I think the tax policies are unlikely to generate enough revenue to fully fund the increases in spending. So I think on the face of it, from the policies that we know about so far, they're consistent with a big increase in the size of the state and a big loosening in fiscal policy relative to current plans. I think the reality might be slightly different due to the economic and fiscal constraints. So we don't think there is scope for a big fiscal loosening relative to current plans. And that may mean that Burnham needs to temper his desire to significantly raise spending, and he may need to raise taxes. So I suppose, in other words, a change in Prime Minister won't change the fiscal realities. And while there might be plenty of talk of spending rises, the reality might be that there's only small spending commitments. So perhaps a more likely result will be that there's an increase in the size of the state with taxes higher on things like capital and wealth and more spending on big investment projects, and a bit more borrowing and perhaps slightly higher gilt yields than otherwise over the next few years or so.
Yes, there's constraints that are really interesting, isn't it? You can change the prime minister. I mean, you could even change the government to a different party, but the economic and fiscal constraints are still there. Namely that no prime minister really wants to or should have policies that boost inflation and interest rates, because that's not going to deliver a good economic response. And then the oversight of the bond market, which we've talked about. And if the bond market thinks they're playing fast and loose with fiscal policy, then it will let them know by raising the costs that they charge the government, which basically ends up being self-defeating. So we don't think there'll be a Liz Truss style event. It's probably going to be much less dramatic than that. It is an interesting question, though, that we have said that perhaps borrowing could be a little bit higher. How much higher could it be without troubling the bond market? If only there was a magic number.
Yeah, I mean, I suppose the answer to that question is that we seem to be quite close to the limit of how much extra borrowing the markets will tolerate. It's not difficult to see why the fiscal dynamics are quite poor, with GDP growth weak and interest rates high. Inflation in the UK has been higher than in the US and the Eurozone for much of the past 4 years. And the UK also has a larger share of inflation-linked debt, meaning its debt dynamics are a bit more exposed to higher inflation than some other countries. So I think, we do seem to be close to the limits. The one thing worth saying is that investors might tolerate higher levels of borrowing if those funds were used to finance greater public investment. And if this is part of a push to sort of a broader push to reinvigorate economic growth in the UK. But I think investors may still worry that a big increase in public investment would, at least in the short term, boost demand relative to supply, and that might exacerbate the rise in inflation and keep interest rates higher for longer. And I think the quality of public investment matters too. If it's not cost effective, if it runs into capacity constraints, then any boost to GDP from higher public investment wouldn't be realised, and that could mean that the debt to GDP ratio is even higher. So I think, in short, to pass the bond market test, I think investors will be looking for signs that the public finances are on a stable footing. They'll be looking for pro-growth policies, I think, and efforts to bring inflation down, or at the very least not to stoke inflation.
This kind of all makes sense while Burnham's team, if not Burnham himself as yet, has been talking about policies that aren't exactly as you would have thought fiscal policies, but nationalising certain industries such as parts of the water sector and also parts of devolution as well. So seems to be an attempt to reach for economic growth through other means, which is a sort of subtle acknowledgement of the fiscal constraints. Now, this is a really interesting issue as well. Both these subjects in some ways can often deliver economic growth if you were to nationalise some sectors, and that if it were to increase public investment, if that investment were spent well, if the government took advantage of being able to borrow at a lower cost than the private sector would, then it might all go reasonably well. But I think the lesson, if you look at other economies in history, is that with both nationalisation and devolution, it's not an automatic boost to economic growth. A lot of things need to fall into place. So you do need to make sure that there aren't cost overruns, which unfortunately the UK has a recent history with when it comes to infrastructure projects. You need to make sure money isn't wasted. And one of the issues, if there's not enough competition in the sector, then your performance and outcomes aren't as efficient as they could be. So I think we are going to hear a lot about nationalisation and devolution. I don't think we would automatically conclude that those policies are going to boost economic growth. It would be a matter of just waiting to see whether they're being done in a way that can deliver some boost to economic growth. Bringing sort of this bit together about what Burnham could do in terms of fiscal policy, non-fiscal policies, is there sort of a way you would summarise how we would, at the moment, in a very uncertain situation, without actually seeing what he's going to do, how we would interpret his likely chances of boosting the UK's medium-term economic growth rate.
Yeah, I think, as things stand, we're thinking that a new top team might not be that much more successful at boosting medium-term economic growth than Starmer. Of course, if fiscal policy is looser, that could have a near-term positive effect on economic growth. But of course, that boost is unlikely to be big if it's partly driven by things like defence spending, as a lot of the UK's defence spending goes on imports. And it could be partially or even wholly offset should taxes rise. So I think it comes down to the fact that the fiscal constraints will be the same. And that will mean that it's pretty hard actually to boost economic growth in the medium term. I guess this raises the question, Paul, could Burnham be Prime Minister in the medium term? And what are the chances of a general election before the scheduled date, which I believe it's due to happen before the 21st of August 2029, I think.
3 years seems a really long time in politics and UK politics, certainly. It's up to Burnham, isn't he? If he does indeed become Prime Minister, then it's up to him when the general election is, or at least if it's any time before then, he can't delay it beyond 2029. I think my answer would be probably no, there's not going to be a general election, not least because, according to the polls, he might well lose it. And people don't tend to call elections if they think they're going to lose it. I suppose the one thing that could change is if there is a bit of a turnaround in the economy, maybe if Burnham himself can contribute to that with a bit of a wave of optimism, then if the polling starts to improve, then maybe he would want to see if he can secure himself a longer term as Prime Minister. And I suppose in that sense, speaking of the economy, this week we published our UK economic outlook, forecasting what's going to happen to the economy for the next couple of years. And, there's a bit of reality in there in terms of the dampening to economic activity in the near term as the effects of the war in Iran filter through. But could also spin it as a bit of a good news story in some ways when it comes to the Bank of England. Is that going too far?
I think, I think our big forecast call is that the bank won't hike rates this year and cut them next year. So I think that is definitely a good news story. And that's in contrast to investors' expectations that rates will end 2027 at 4%. I suppose we wouldn't completely rule out the bank raising rates in July or September to guard against second round inflation effects. It's very possible that the hawks on the MPC could repeat their votes for a 25 basis point hike. Catherine Mann could join Pill and Green as well. But I think much really depends on the four centrists, I suppose, on the committees. That's Bailey, Breeden, Ramsden and Lombardelli. And at the moment, there's no signs of the hawkishness of Pill and Green being replicated amongst these centrist members. So we don't think the hawks on the MPC will get the 5 votes for a rate hike soon. And actually, based on our forecast, we don't think there's a strong case for a rate hike either. If you look at the UK's labour market, it's looser than both that in the Eurozone and the US. Growth is likely to be softer than in the US. So we don't actually think that the Bank of England will follow the crowd and hike rates. And we think that rates will be cut to perhaps to 3% next year.
It's turning out to be quite a big call, that. When you're saying that Bank of England isn't going to change interest rates, it sounds like it's not necessarily a big call, but over the last few months, pretty much the markets have persistently and still are priced in interest rate hikes. And majority certainly of economists are forecasting hikes as well. So it is quite a big call, and especially those cuts for next year. That's certainly something that will catch the market out. And also it looks really striking when you compare it to what's going on in some other central banks as well. We know the ECB has already raised interest rates, and our forecast is that the Fed will raise interest rates later this year, perhaps 3 times with 325 basis point hikes. So this divergence in monetary policy between the UK, to some degree Europe, but also bigger against the US is really going to play out in the financial markets. And that's why we think 10-year government bond yields in the UK will fall further than government bond yields in other areas, and why the pound could weaken against certainly the US dollar as well. We've laid out a forecast in the economic outlook where inflation rises basically from just below 3% now to about 3.5% around the turn of the year, but gets back down to 2%. the situation in the Middle East and what's happening with the oil prices is still moving quite fast. Do you have any feelings, Ruth, about if we're wrong on that inflation forecast, in which way it would be?
Yeah, I mean, we've already revised down our inflation forecast, given the recent falls in energy prices. So we think inflation, as you say, will rise to a peak of 3.6% at the turn of the year, and that's lower than our previous forecast of a rise to 4.3%. And clearly, the latest falls in energy prices may mean the peak in inflation is perhaps a bit lower still. In terms of that view, I suppose we think that the weak labour market will mean that employees won't be able to negotiate faster wage growth, and the weak economy will mean that firms will force firms to squeeze their profit margins. And I suppose this is a very different picture to what we saw back in 2022, when a shortage of workers and strong demand led to faster wage growth and more support for profit margins. So it's without these second round of inflation effects that we think that inflation will fall to 2%, the 2% target next year, and actually possibly even below it in 2028.
So bringing all this together then, we've got a situation where we think if and when Burnham becomes Prime Minister, there's going to be a lot of noise and some big sounding economic policies. But because of various constraints, they won't actually be that big. And our view is that he is unlikely to have that much more success at boosting the UK's medium-term economic growth rate than Starmer was. But you can paint a story of how the economy might help him out at some point, perhaps, if not in the next 6 months, but certainly sometime in 2027. So maybe he'll turn out to be a luckier Prime Minister than Starmer, and maybe that will be something that will help him on the way. Now, of course, he perhaps could become Prime Minister on something like the 17th of July. That's just 2 days before the World Cup final. So if he were really lucky, then of course England would win it. But that is not a forecast. That is just hope.
Paul Dales and Ruth Gregory talking about a Burnham government and why we're expecting hefty rate cuts from the Bank of England next year. I will add their outlook to the podcast notes. Do read our other outlooks and don't forget to register for the coming week's drop-ins. But that's it for this week. We will be back next week with more from the world of global macro and markets. Until then, goodbye.